Hello and welcome to MoneyTree Software's training video for the Special Income and Expense Planner for the Silver Online and Silver Financial Planner tool. The Special Income and Special Expense Planner are the most common areas where input mistakes are made within the Silver program. In today's video, I'll show you what those common mistakes are, and I'll show you the proper way of inputting the assumptions so that your projection runs as planned. The Silver Online and Silver Financial Planner tools are goal-based planning models. This is the core reason why the Special Income and Special Expense Planner are so prone to mistakes. The Special Income and Special Expense Planner are exceptions to the pre-retirement cash flow rule of Silver. This means that any special income or special expense that is running in the pre-retirement years will not be offset by earned income or regular personal expenses. They will be directly affecting the assets. First, let's go over the basic assumptions that I'm going to use for this case. Right now I have two individuals that are both age 60 and both retiring in 5 years. If we go to the income section, you'll see that I have input that they have a gross income collectively of $160,000 a year. For this scenario, I have not included any pension income or any Social Security income. When we go to the asset section, we'll see that these individuals have $400,000 in a money market account. For the sake of simplicity, this is the only asset that I've included. There are no additions going to this asset, and as well, if you see here in the rate section, I have made the growth rate significantly small. We'll start with the special expense section. Here I have an input mistake for a mortgage entry and a correct way of handling the mortgage entry. Here in the expenses section, I have $65,000 of annual expenses for now and in retirement. Add on top of this the mortgage of $26,000, it should still be enough to be handled by the earned income of the individuals. However, because Silver is running in a goal-based model and the special income and special expense planners are exceptions to the pre-retirement cash flow rule, this will not be handled the way that you would assume. Now let's take a look at the report and see how this mistake is affecting your projection. When we look at this taxable savings page, we can see that 100% of the mortgage expense is being taken from their $400,000 balance. This is happening regardless of the fact that they collectively have $160,000 of gross income. Because this expense is coming solely from this asset for the 5 years before retirement, this is throwing off what we would project the assets to be at by the time of retirement. Let's now take a look at the proper way to handle the mortgage. We can see in the assumptions for the mortgage mistake that the expense begins in the current year and goes for the remaining term of the mortgage of 10 years. This is a mistake because 5 of the years are happening in pre-retirement, where their earned income cash flow can account for this expense. Since their pre-retirement cash flow can handle the expense, what we'll want to do is put it into the special expense planner and have the expense start in the same year of retirement. We would then adjust the term or number of years to reflect the number of years of payments remaining after retirement. Now let's take a look at the report and see how this is handled. We can now see on the taxable savings page that nothing is coming out of the asset until the retirement age. We can also see this on the retirement capital analysis page. This same principle applies to the special income planner. We'll turn off the special expenses and we'll turn on the rental mistake here in the special income planner. Again, this special income is running in the pre-retirement years. Let's take a look at how this is handled in the reports. By looking at the taxable savings page, we can see the opposite effect that the mortgage was having. This special income is reinvesting 100% to the assets. Unless these clients are actually saving 100% of their rental income, this would be an incorrect assumption for the projection. Now let's take a look at the correct way to enter the rental income. You can see in the assumption for the mistake that the income is running in the pre-retirement years. The same way that the mortgage was coming in the pre-retirement years, it is just being handled the opposite way, in falsely inflating the assets instead of falsely drawing them down. To correctly input the rental income, we would start the income in the same year as the retirement. We would then, if applicable, adjust the term. We can now take a look at the report and see how the rental correction is being handled. By looking at the taxable savings page, we can see that there is no pre-retirement reinvestment of this income. We can also see that on the retirement capital analysis page. Now that we have our special income and special expenses correctly input, we can then put in other assumptions for retirement, such as Social Security, pension, or any other retirement assets that are available. If you're wondering how to handle the mortgage expense in the pre-retirement years, it is best just to throw that expense into the regular expense section here. We'll put a total of $91,000 in for pre-retirement. Now let's make sure that the correct entries are turned on for the special income and special expense planner, and we'll take a look at the report and see how it looks with everything going on. We can see here on taxable savings that nothing is drawing or adding prematurely to the assets. We can now see on the retirement capital analysis page our spending need is what would be expected. We have a net effect of the rental income and the mortgage payoff happening in the other income and expense, and we can see that the mortgage drops off at the proper term. As well, we can see that the rental income continues. You can also see this on the cash flow page. If you would like to capture the surplus here into the assets, the best way to handle that is through the asset inputs. To capture the surplus, we're going to go to the asset section. We can either add a new asset or add additions to the current asset. I'm going to add an asset. I'll call it more savings. I'll put in the amount to leave them still some discretionary spending, and I'll have it run for the 5 years before retirement. Once that's in, we can take a look at the cash flow page, and we can see that our surplus is not as much, and that we have additions going to the assets to build for retirement. I'll now briefly go over the input differences between Silver Online and the Silver Financial Planner desktop tool. In the Silver Financial Planner tool, the Special Income and Special Expense Planner are both inside the Income and Expense area here. This concludes our video on the Special Income and Special Expense Planner. If you have any feedback or questions, please call us at 877-421-9815, extension 0 for support, or send an email to support@moneytree.com. Thank you.